Hey everyone, welcome to this explainer. Okay, I am so pumped you're here today because we are tackling a topic that has been absolutely dominating financial news feeds, taking over social media, and hijacking expert forecasts. We're talking about the viral warnings of a massive systemic market crash coming in 2026. So is it fact? Is it fiction? Or are we truly standing on the verge of a total collapse? We're going to break it all down together using nothing but hard, objective data.
And listen, the stakes here are incredibly high. A financial heart attack. That's not just some random internet troll talking. That is a direct quote from billionaire investor Ray Dalio. He's literally warning us that soaring U.S. debt and geopolitical tensions could trigger a massive crisis by 2026. And, he's definitely not alone in thinking this. JP Morgan Research recently put a 40% probability on a U.S. or global recession by late 2025 or early 2026. Those are incredibly heavy predictions from some of the biggest players in the game, and it's exactly why we need to unpack what's actually happening beneath the surface.
So here is our investigative checklist to separate the facts from the fear-mongering. Section 1, the 2026 crash warning. Section 2, market overvaluation. Section 3, the sovereign debt tipping point. And finally, what leading indicators are actually saying. Okay, let's dive right into Section 1, the 2026 crash warning. With the IMF projecting global growth to slow down to 3.1%, plus rumors of a catastrophic crypto meltdown swirling around, a lot of the internet is totally convinced a systemic peak is imminent. Which leads us to Section 2. Is the market actually overvalued? Let's step away from the loud headlines for a second and check the real valuations. To do that, we are going to use a classic reality check called the Buffett indicator. Yep, named after the legendary investor Warren Buffett. It's actually a pretty straightforward metric. You just calculate it by dividing the total U.S. stock market value by the annualized gross domestic product, or GDP. Basically, it expresses the hype and value of the stock market in terms of the actual tangible output of the economy. If the market's value is growing way faster than the country's actual economic production, well, we might just be sitting in a giant bubble. And guys, here is the high-impact punchline. As of March 2026, the total U.S. stock market value sits at an absolutely massive $69.15 trillion, while the annualized GDP is $31.57 trillion. If you divide those two numbers, you get a Buffett indicator of 219%. Let me tell you, that is a staggeringly high ratio by historical standards.
So what does 219% actually mean for us? Well, it means the market is flashing a bright red warning sign that says strongly overvalued. In fact, it sits about 65% or 2.1 standard deviations above its historical exponential trend line. Statistically speaking, that is extreme. It's basically telling us that the market is currently priced for absolute perfection, sitting right on top of highly elevated expectations.
But hold on a second. Before we all run out and hit the panic button, we really have to ask, is this the whole story? As with literally any single financial metric, looking at it completely in a vacuum can be incredibly misleading.
Now, what's really interesting here is that there are two major modern caveats to the Buffett indicator. First up, interest rates. They're relatively low right now, sitting at about 4.30%. Compare that to the dot-com bubble, when the 10-year Treasury was yielding something like 6.5%. When bonds don't pay out as much, investors are naturally driven towards stocks to find returns, which inherently pumps up those stock prices. Second, we have to talk about international sales. Massive U.S. tech giants, like Amazon, for example, sell globally. That massively boosts their stock price on the U.S. exchange. But those overseas sales aren't actually counted in the U.S. GDP. So globalization naturally inflates this indicator today compared to a few decades ago. Yes, stocks are highly valued, but the mechanics of modern globalization and interest rates offer some very real justification for it.
Let's move on to Section 3, the sovereign debt tipping point. Let's look exactly at when national borrowing hits its mathematical speed limit.
To anchor this somewhat abstract concept of debt in reality, we're going to look at this concrete landmark policy research working paper from the World Bank. It's paper 5391 titled Finding the Tipping Point When Sovereign Debt Turns Bad. Look, this isn't just internet speculation. This is rigorous, hardcore institutional research. They analyzed decades of data across 101 countries to figure out exactly when government debt stops helping and starts actively destroying economic growth.
And the absolute crucial point here is that they mathematically mapped out the specific tipping points. For developed economies, the threshold is a public debt to GDP ratio of 77%. For developing economies, mostly because of less mature financial markets and different institutional structures, that threshold is actually even lower, at 64%. Now, below these numbers, a country taking on debt can actually loosen credit constraints and fuel growth. It's kind of like having a credit card. Great for buying a car to get to work, right? But it's totally toxic if you're just using it to pay off your other credit cards. Once you cross above these exact thresholds, that national debt turns entirely toxic.
And this brilliantly illustrates the penalty for crossing that line. Every 1% of debt over the threshold costs a developing economy 0.02 percentage points in annual real GDP growth, and it costs a developed economy 0.017 points. Now, I know that sounds like a tiny fraction, right? But compounded over time, it is literally devastating. The World Bank highlighted Nicaragua as an extreme cautionary tale here. By ignoring this threshold, Nicaragua lost an estimated 4.7 percentage points of real GDP growth annually. Cumulated over 28 years, that resulted in a staggering 264 percentage point loss in growth. That insidious long-term erosion, that is the true danger of the debt crisis Dalio is warning us about.
So let's see how this all builds in Section 4, what leading indicators say. We're going to cross-examine all the doomsaying with real-time economic data. Despite the massive viral recession fears out there, the U.S. Leading Economic Index, or LEI, actually surprised the experts in April 2026. It didn't plummet. It unexpectedly inched up by 0.1% to reach 97.4. Now, this follows a decline in March, but seeing it suddenly tick upwards shows an unexpected pocket of resilience in the near-term economic trajectory.
So why exactly did it tick up? Well, it's because we currently have two massive, opposing forces basically playing tug-of-war with the economy. Pulling the economy up, we have rebounding stock prices, an increase in multi-unit building permits, and incredibly strong investments in AI infrastructure and energy production. But pulling the economy down, we have very weak consumer expectations, sluggish hiring data, and painfully higher gasoline and energy costs. It creates this absolutely fascinating tension right now. You have heavy, optimistic corporate tech investment pulling hard against a struggling everyday consumer whose purchasing power is slowly being eroded. When you weigh all those opposing forces against each other, you get this forecast. I really wanted to juxtapose the hyperbolic internet rhetoric of a total apocalyptic meltdown with the dry, stabilizing reality of the data. The Conference Board is actually forecasting a 1.7% year-over-year US GDP growth for 2026. Actually, scratch that. They recently revised that estimate up slightly from 1.6%. It's definitely a slowdown for sure, but 1.7% growth is unequivocally not a recession.
So bringing all of our evidence together today, here is the final verdict of our investigation. The global economy is fragile. It is highly leveraged, with many nations sitting well above those World Bank debt thresholds. And the stock market is running incredibly hot by historical standards. Furthermore, the LEI's 6-month trend does definitely remain negative. However, due to lower interest rates, globalized corporate earnings, and powerful ongoing AI investments, the economy is still fundamentally growing. A catastrophic crash is just not imminent based on the data we have today.
Which leaves us with this final, truly fascinating question. With global debt soaring well past historical tipping points, but economic growth stubbornly persisting through sheer technological investment and structural shifts, are we really facing a delayed 2026 crash, or have we simply entered a brand new, highly leveraged economic normal? Thank you so much for joining me on this explainer today. Keep questioning those crazy headlines, keep looking at the hard data, and I will see you next time as we continue to explain the forces shaping our world.